Currently, the stock market is setting new highs. The Dow Jones Industrial Average is setting new highs. The S&P 500 is very close to setting new highs. And I think we need to put this in perspective. A lot of people are asking questions as to the sustainability of this move to the upside, which is valid. I think to gain some sense as to why this is happening, we have to take a look at Federal Reserve policy, and we also have to take a look at corporate earnings. Both of those items have been very supportive of higher stock prices, and I view both of these issues are still at play for the vast majority of the remainder of this year. So we're suggesting to clients, if we see a correction in stock prices down from where we are today, we're probably not going to see, at least over the short to intermediate term, a dramatic move back to the downside. But could a correction occur? And what I mean by a correction is a 5–10% or so move back on the downside in stock values, and it very well could happen. Take, for example, some historical data. If we look back in history, we can look at different kinds of corrections in stock values and break them down into 4 categories. There's what's known as dips, and those are moves right around 5% or a little bit more than 5%, where stock prices just move down very, very little. There's a moderate correction, and moderate corrections is defined as moves of 10% or more on the downside. If a severe correction is classified as a move of 15% or more on the downside in stock prices from a high. And a full-fledged bear market is considered a 20% plus move on the downside. Now let's look at the frequency, at least going back over the last number of decades, the frequency of these kinds of moves back on the downside. A dip normally happens about 3.5 times per year. So traditionally speaking, you see about 3.5 dips within the stock market of 5% or more each and every year going back, at least on average over a long period of time. The last time we've seen a dip like this was back in September of last year, September of 2012, where the stock market corrected by about 5%. So we're due a correction of that kind in January of 2013. Now that it's March, we're overdue that kind of a dip. Moderate corrections occur 1.1 times per year, and those are corrections, again, of 10% plus. Traditionally, you get about one of these a year. The last time we've seen a 10% correction was April of 2011. So we're coming up to the second anniversary of not a 10% plus move on the downside, which is rare. Normally speaking, we see one of these each and every year on average. Severe correction, we see severe corrections about once every 2 years. And again, this is a correction of 15% or more. The last time we saw a correction of that magnitude was back in April of 2011. So we're coming up to the second year anniversary of a severe correction. Now, a bear market of 20% or more, we normally see one of those about once every 3.5 years. The last time we saw a major correction of that magnitude was back in 2009. So we're coming up to an environment where we wouldn't be surprised, as far as the timing is concerned, of the onset of a major secular bear market, or a major cyclical bear market, I should say. We don't think that's going to happen this time around, because the 2 pillars that are really driving or supporting stock prices, Federal Reserve policy and rising earnings flow, are probably going to continue through the majority of 2013. So if we see a correction in stock prices, we would use that correction at this time anyhow as a buying opportunity. If you're light in equities, or you're thinking about adding more equities to your portfolio, we would suggest if a correction like that occurs, that might be an opportune time to take action.